Hello, this is Dr. Hoppert again. I'd like to speak to you about some topics that relate to this week's lesson. The first of those topics is the efficient market hypothesis. You've probably talked about this in a finance class or in another class, but just in case you haven't got too much about it, I'd like to cover it a little bit in my discussion today. First thing I'd like to say about the efficient market hypothesis, this is something that became kind of a revolution back in the 1960s. The efficient market hypothesis basically says that whatever information is available that's public or that anybody can get their hands on in any way, that's all embedded in the stock price. So the stock prices as you see them, you can't predict those prices using information that's publicly available. You can't predict what they'll be in the future. For example, you can't take accounting reports, you can't take past stock prices, you can't take any information and use that information to predict future prices. You can predict future prices, of course, but the prediction of future prices is what we call a random walk. That means whatever the price is today, we expect it to be the same tomorrow, if you have to make a prediction. And you cannot improve that prediction any by using accounting information. This is a very important point because it says a lot about how accounting information can be used. That says there's a lot of debate about the efficient market hypothesis. People say, well, if it's really efficient, then who needs accounting information? Why do you need it? What good is it, at least as far as your investors go in the stock market, because you can't use the information to gain any kind of advantage. Well, that's not exactly right. A couple things is that we know that when accounting information is released or published, for example, when a company publishes its earnings report, we know that there's an immediate, very strong stock market reaction in cases where the announced earnings is not what was expected. If the analysts all say it's going to be $1 a share and it comes out to be $1 a share, there's no reaction because everybody already expected that. That information was already impounded in the stock price. But if we expect $1 per share and it turns out to be $2 a share, there's going to be a reaction very quickly. In fact, it's going to be a positive reaction and the stock price will likely jump up. So that's what the efficient market hypothesis is about. But some people will say it's not really efficient, and there's a lot of accounting research that's been going on. They've shown companies that don't exactly follow the paradigm very well, and people have argued that, oh, we just had a 20% drop in the stock market. How could that be if it was an efficient market? Because what's the new information and all this kind of stuff? Well, some comments on that. The first thing is the accounting information is not the only source of price movements. Price and stocks are affected by other things: interest rates, inflation rates, fear of the economy, many different things. In fact, some analysts have said, and I don't know the recent numbers, but they said perhaps 85% of all volatility in stock prices is caused by market factors, not by what happens at the individual company level. So in other words, if you buy a portfolio of stocks, the performance on your portfolio is likely to be determined very, very much by the market, especially if you have a portfolio representative of the market. So what good is accounting information if you can't use it to gain any kind of special returns in the stock market? What good it might be? Well, first thing is it is important in terms of helping you identify what your risk preferences are. I think people pretty much agree with that. In a so-called efficient market where security returns have a normal distribution, there's only two important things: the mean and standard deviation of the return. The mean and standard deviation, basically, and how the stock varies with the rest of the market. The standard deviation is a measure of risk. If you have two stocks, one has an average return of 10%, the other one has an average of 10%, but the second one has a standard deviation of 4, and the first one has a standard deviation of 2, you prefer the one with smaller standard deviation because it's less risk, less volatility. So that's really a kind of a little bit about the efficient market hypothesis. I will talk about another topic that relates to today's discussion is so-called agency theory. That's referred to in one of the readings. The idea of agency theory and positive accounting theory, both of these concepts kind of go together. Positive accounting theory deals with not so much about what accounting methods should be used or how they should be used or the issue of what the accounting rules are. It's really the question about what choices do managers make in choosing accounting methods. Now that's an important topic in this class because in this class we're going to do more than learn what the rules are. We're going to learn why people choose these rules and how they affect things. And so this study of how people use accounting information, how they choose accounting information, and particularly managers if they have a choice of, say, LIFO or FIFO, why they might pick LIFO instead of FIFO, those choices are important to positive accounting. Now, a theory underlying that is agency theory, which basically says that, more or less, that managers act in their own best interest. If there's a stock bonus, if they get a 10% stock the bonus, if they get a 10% increase in earnings, they'll try to get the 10% increase in earnings to get that bonus. In fact, they might even fudge the earnings a little bit by manipulating the accounting, and if they can change the accounting method, say from FIFO to LIFO, and that will get them an extra couple percent earnings, and that will get them a bonus, they will do that in a lot of cases, not everybody, in every case. And so positive accounting deals with the fact that managers pick methods that are in their best interest, and sometimes in the best interest of the company. It all depends if the manager's interests are aligned with the company's interest. If the manager's and company's interests are aligned with each other through the correct incentive type of plans, then it's the same thing. But that's not always the case. And so just wanted to give you a point to clarify what positive accounting theory is. There's been a lot of research that has supported this, and the research has shown that, for example, an oil company may choose LIFO during an inflationary time for so-called political cost. Political cost means that they have these high profits because of increasing oil prices, and some people call them obscene profits, and as a result they put an excess profit tax on the oil companies, and to avoid that they would rather use LIFO to keep their profits down. We've also shown that a related thing with the so-called information market efficiency, we've shown that when companies switch to LIFO, it lowers the earnings, but we know it gives them a better tax shield. And so what would you expect the reaction to be? Well, the research has shown that the earnings go down, but there's a positive market reaction because the market's intelligent and they realize that the companies are going to pay fewer taxes. And by paying less in the way of taxes, there's more profits and it's better for the shareholders. So those are some quick comments on the efficient market hypothesis, agency theory. These are quite rich areas, a lot I could say. So these are sort of a summary in a nutshell in a non-technical fashion. So I hope this is helpful. Thank you.